So we've addressed this before. We've reviewed this before. And here we did get an update, correct? Yes, it updated for us. So here we are. I believe it was at 5 this morning. Let's take the view indicator details and let's go. I'm going to go back a day. I thought it was at 5 and 7 this morning. No, it was still at 7 and 6. Yours might look different. I apologize. Yours might look different than mine. I might have adjusted these criteria and saved them a different way with the programmer's help for looking for something specific. That's okay. But here we are. Either case, we're at a bearish sell warning. And we have one of these a few weeks ago. We talked about what goes into the market sentiment tool, but Jerry's question is that he says no specifics about the market sentiment is organized by PowerOptions. He said market sentiment is organized by PowerOptions and your general commentary. Yeah, I use this to follow my trades. Okay, I use this to help me decide when to enter, exit positions, when to do income methods on the positions I have. I had 3 bull puts expiring today, Mark. And normally, as you know, when I have 3 that expire, they're usually 2 weeks out. Following the bull put weekly search in PowerOptions, I'd open 3 new ones on Tuesday, because remember the market's closed on Monday. I am not planning on opening new bull put spreads on Tuesday because of this. I expect to see when this triggers, especially at this high, 7 to 6, a bearish sell. It's not a warning. It's not a light sell warning. It is a bearish sell. 7 to 6. Of the 13 indicators, what do this mean? 13 of the indicators, things such as put-call volume ratio. Number of days SPX has been up. That's almost bearish. That's pretty much bearish. This hasn't triggered yet. If SPX is up on Tuesday, that's going to trigger. We're going to be 8 to 5. Gap over the SMA 20. That's almost bearish. The percentage of stocks across the market over the 20-day moving average, still in the middle. Number of stocks seeing their new 52-week high went bearish. VIX is bearish. Talk about that in a moment too after I finish this. Trend is even. The RSI of SPX sitting there almost at bearish. Number of days over SMA 20 bearish. Number of days at the SPX over 100 bearish. SPX, the gap, the size of the gap over the SMA 100 just entered bearish. Percentage of stocks over the SMA 100 just entered bearish. What does all of that mean? Each of these criteria you're seeing have fences set on them based on the histogram of occurrences over a long time period, many decades, 10, 12 years. What does that mean? It means that here's the occurrences of the percentages of the percentage of stocks that have hit the new 52-week high. Right now we're at this range. Okay, we're up here. 13% of stocks, looks like, 12.7, 13% of stocks are at a new 52-week high. Oh, I'm sorry, oh no, it's a ratio of high to low. I'm sorry, it's a ratio of high to low. It's at 13% positive to stocks highs over the stocks lows. What do you see here? I know it might be hard to see, but very infrequently on this histogram do we, oh, it's a highlighter. I wanted the pen. Very infrequently do we go over this. Okay, does it continue up to go to 18 and so forth? So what does that technically mean? It technically means that it's going to want to revert back to this range, and in order to do that, it means the stocks hitting a 52-week low are going to go up, and those hitting the 52-week highs are going down, so this will go back to a normal range. Just like with the number of SPX days up, put-call volume ratio, and more. Okay, so let's see here. What does all of that really mean? Here, we were at a sell warning yesterday or a few days ago. Yeah, sell warning for 3 days, 4 days in a row, and then we hit the bearish sell. This changed my approach. Okay, I had mentioned that I probably should have done it. I'm not going to say I was wrong because it's a married put position and it's protected. I had mentioned that for the married put position on the index, I could have bulletproofed it today before earnings. And I was going to pull the trigger on that today because the bearish sell clicked in. Why still continue the position with a 7% risk if the market pulls back due to this weakness and the bearish sell warning on Tuesday? Why not bulletproof it now? I might regret it, but if it stabilizes and it stays around 45 or goes up a little bit more on Tuesday, I'm definitely bulletproofing that trade. No questions asked, because it'll still be at a bearish sell. Fabrinet, I want to do an income method on too. I can't bulletproof it, but I can cut the risk down by half, and I'm probably going to do that too. And because I'm seeing that bearish sell, what am I not doing, Mark? I'm not going to enter bull put credit spreads until I see that go back to neutral. I'm not going to take the chance right now. Okay, so it also, oh, I'm sorry, I should have stayed. I'm sorry to click around. I should have stayed in the portfolio if it's still there, and it's not. Okay. Bull puts. Let's go back here. AMD, Goose, IB. Okay, I haven't been updating this one. In the Fusion portfolio, I made 2 other adjustments today. One on. So what did I have? I had on as a married put position that didn't do too well for me in the last year. Let me go to a 1-year chart. It was a hedged position. Shortly after I got into the position, it dropped down to about $17 per share. I think my cost basis was $22.23 with a 25 put. I think I got in here. Very shortly after that, it fell. I was going to do an adjustment, but I saw it coming back up. And I should have done something here, but I didn't. And I really should have done something. It was back to my cost basis. I was at about a 2% loss. It was a max of a 7% loss, I think. And then it pummeled again. Okay. So I should have done something, but it kept doing this things here I didn't. I played it wrong. But then it just went up like this. Okay. Now there is a MACD signal warning here. It is stabled off a little bit, but I was coming up to expiration with that put today. Max loss is 7%. What did I do? I continued this out to July with a married put that was, if you opened it today, was only about a 3.5% risk. But I'm factoring in most of the 7% risk, so my risk went up to about 10.2. I'm taking that because this stock is going in the right direction, and earnings are coming up, and I have ways to manage it. However, I had a similar situation in Dell. Okay, and Dell was a married put coming up to expiration today. I had traded it and tried to roll down and adjust the cost basis in the put, but that increased my risk. I'm holding about a 10% risk on the position. And the sell warning came up, and this just zip, little back, zip, and it's just, I'm expecting it to just do this. And it looks like that'd be great opportunity to do income methods, but unless you time it right, you hurt yourself. And that's what, honestly, that's what I ended up doing. Keep in mind, I got this stock over here at about $64. I'm down 23% on just the stock ownership itself. I saw the sell warning. I'm not confident in this stock going bullish. I'm not confident in continuing this trade. I was more than happy to take the 10.4% loss and close Dell today because the sell warning is in. If there was a light buy warning on the market, Mark, and I had reached this point, I probably would have extended Dell, been comfortable taking a 13 to 14% risk for another 4 or 5 months to try to negate that with income methods, expecting a bullish move and take it out. No confidence in Dell with that sell warning on right now. Didn't continue it. Just took the 10% loss on the position. More than happy with that. And it gets it gets this albatross off my shoulders, for lack of a better term. I wanted to play it better, but I did play it through here. And at one time I did have a profit here, believe it or not. That was the way I structured it. I had a profit. No, I didn't. I had a profit here almost. It was a loss of 1%. I didn't liquidate it, and then this just happened. And then I was stuck in that place again where I was at that 8-9% loss and just lost the time value. Could I try to continue this trade to make it look better in the track record, to cut the risk from 10% down to 5% in the next 5 months with proper use of the income methods and generating income? Maybe. But seeing that sell warning, now is not the time. That guided my decision to get me out of the Dell trade, take the loss, even though earnings are coming up in 35, 40 days, and move on. Okay, so what are my expectations? My expectations are I'm going to find the home page where we have that up again, and I'm going to go back to the indicator details. All right, my expectations are is we're going to start to see an easing. I'm not going to say on Tuesday. I'm not going to say on Thursday. I'm not going to say it's going to happen in 5 days from now, 5 business days from now. It's going to last for 4 days, and it's going to be a drop of 6% across SPX and the broad-based markets. I'm not saying that. I'm saying I expect an easing, a breath, a relief, a sigh of relief, and a pullback sometime in the next 3 weeks. Earnings can still be strong, but I mean, over time, the history of when the SPX is this many days over its 20-day moving average, and this many days above its 100-day moving average, and this many, the gap is this big over the 100. It very rarely continues beyond that. So historically, we're being shown, hey, market conditions can change. We all know there's different markets from time to time. But again, this is what we plan on. Does it guide my trading? Absolutely. When I've hit this point, I have no plans now to enter any new bull puts. The 3 I had today expired worthless for full profit. I wasn't too worried about that because they were still far enough out of the money that even if the correction or a correction or an easing started today, Mark, it would have had to been drastic to get to the short put strike prices on my positions, those 3 bull puts I had open, okay? Didn't do that. So I wasn't concerned about that, but I'm not planning on opening anything next week until I see this shift. How is this going to shift? These have to ease. The market has to do something to where these all move back to that mid-range, that neutral range, and that would mean the stock is falling. The markets are falling, excuse me. Oh, and you had Sam, you had commented that MACD is a smart tool for entries and exits for shares when crossed the zero line. Yes, and you can see that, yeah, this has been crossing up and down, and when it crosses the zero line there, like I said, you saw it, and that's usually an indicator for me. When it hit this and it crossed here and it dropped below the zero, that's usually my double trigger to get out of a position. Why didn't I? Hope. I was hoping on a married put position that had like a 9 or was at a 9.8% loss, and the most I could lose was 10.2, so why not leave it open for another 40 days in case it came back up to here and it would only have been a 3 or 4% loss. That was hope. I should have closed it out. You're absolutely right. But hey, it just meant I would have been out a month and a half earlier with a 9.8% loss instead of a 10.2. But you're absolutely right. And in the Blueprint Owners webinars, Sam, that we've had, those are some of the triggers I look for. That's why it's selected when I link to big charts, because I look at that MACD for those entering and exitings or decision-making process and doing income methods as well. But right now, because the market sentiment, oh, another great idea, for positions that I have, oh, shoot, wrong button. For positions that I have, now that I see it, what are we talking about? Well, I'm going to do something different with the index, but I see that market sentiment come up. I'm in at 42.29 with a 47 put on the index. I see that come up. If earnings weren't coming up, now would be a great time to sell a February 47 call, seeing the market sentiment go that way. Why? Because what we talked about earlier in relation to Terry's question, we didn't delve too deep into, but in relation to Terry's question about, you know, if you're expecting growth and appreciation, should you enter the collar? And I said, no, I think that's wrong. So I'm still expecting growth on the index. But what did we see? We saw the sell warning come up, and it's had a nice run up of 6%. Fear about a pullback coming through. It's at a near high, and get $1 for that 47 call, which is going to cut down a third of my maximum risk. Sounds perfect for an income method number 1. This would be a great time to do that income method number 1. Sell that call, generate the income, sell the call properly, generate the income, knock the risk down by about a third, the monetary risk down by about a third or half, and then still have downside protection cut down to 4.9 with still a reasonable expected return. But again, what's going to happen? If it's expected the market's pulled back, why not take that extra $1.25 right now? I'm not necessarily doing that. Why not? Because this is the premium out to February 14th that matches my expectations of limiting the maximum risk to a third or a half of the maximum risk I started with. But like I said, I can bulletproof this position, and earnings are coming up around that February 14th. I don't want to be in a short call with earnings, but I'd love to be bulletproof with the sell warning in place on the index and the upside open for earnings come out, which could still surprise even in a pullback period. And that's what I'm going to look to do on Tuesday for the index position. Bulletproof trade, unlimited upside remaining, going through earnings with no risk with the sell warning in place. That's what I'm going to look to do. I'm not, although selling a call might be a good idea for Terry now on some of those positions he's had that have moved up with the sell warning coming up, this might be a great time to sell a call. I'm not going to say it's a great time to do bear call credit spreads, but it might be as well, as long as they're far enough out of the money with a good enough probability. Okay, so that's what the market sentiment is telling me. This did guide my decision-making process today. I didn't wait till only just to expiration, which I never should do, and I learned my lesson now in some of those married puts I mentioned with Dell and NRG, which was also liquidated today because I saw the sell warning and didn't see any potential for it to have further movement, no reason to continue the trade. But on ON, I did decide to, even with the bearish sell in place, because earnings are coming up and it is going in the proper direction, and I can do income on it next week, even if this pullback starts, even if this easing that I think is coming because of how I use the market sentiment tool is coming, and that's what I expect to see. Once it goes back to neutral, once it gets off of bearish sell, we do see an easing of those, and the only way to ease it is to see a market pullback. So once I see it go back to neutral, I will start doing the bull put credit spreads again, but I'm not going to enter those bull puts when I see a bearish sell warning in place. And it might even trigger higher. It's possible we might see a strong bear sell in the next week. As I mentioned, if Tuesday the market continues up a little bit and a little bit, it doesn't start the ease, this could go to a more unbalanced bearish signal. Guys, in that case, I might just step out. What did I do today? As far as a new trade, probably the same thing Sam did. He sent me an email about some of the trades he made, and he talked to us about it today, and he also mentioned to me about SVXY and UVXY. What I did today was picked up about 1.8% of my total portfolio into VIX calls, which is one of the bearish indicators. The VIX here is telling me it's at a bearish time. It's at 12, which means it's a bearish indicator. So what does that mean? It means very rarely does it stay below 12 for too long. How does the VIX move back up? The market falls. So I bought some calls on the VIX today, about 7 or 8 calls on the VIX. When I saw it breach below, it actually opened below below 12 this morning. I couldn't get in then, but when I saw it at 12.20, I bought some of those calls on the VIX. Okay. Let's see here. Chuck says, you never seem to mention bear calls. They have worked well for me. Okay. And Faldo, based on what you've been telling me, I'll be doing a lot more bear calls next week, and I might be too. Here's the trick I've had with the bear calls. Okay. We did this. There was a discussion, and the discussion was in the presentation Chuck called, you can find it on YouTube, but it's also on PowerOptions. No, it's right here. It's also on PowerOptions. Free webinars, option strategies. Credit spreads beyond the basics, parts 2. Answers to question in part 1, and a look at how bear call spreads performed in 2018. Looking for the same kind of probability of 85% or higher in 2018, where half of the year, 6 out of the 12 months in 2018 were negative. You know what was astonishing about that study for me, Chuck? When we looked at it, the structures I use for the bull put credit spreads, if I traded them all year, that means including all the way through that decline of 2018 from October to here, which I didn't. I stopped up here. But even through the February 5th through 9th crash, that other decline in May, and that other little hiccup in June, have I done bull puts this whole way, it still would have been at a profit of about 10.9%, even with taking a 45% loss on the 3%, an average of a 45% loss on the allocation I had on the 3 bull puts here during that February 5th to 9th crash. It still ended up positive, even going through the end here, okay, based on the long runs. Closing out here was more like a 25% gain, which is what my targets are. Actually, my target's more like 30%, but that's a little different discussion there. So what did I do? Over that second part there, credit spreads beyond the basics, part 2, this same time period, I ran almost the same criteria reversed for bear call credit spreads, looking for 85% probability. Stocks where the MACD was negative and below the signal line. Stocks were under the SMA 50. No earnings coming up between now and expiration. Weaker performing stocks. Because of this run in here with the bear calls, and because even of this little run here, and even, surprisingly, this little run back up here in November and run back down, over that same time period where the bull puts, if you had traded them with that structure, and we saw a 10.9% gain, reversing it to bear calls over that same time period, reversing the criteria, using for bear calls over that same time period, closing positions if they hit a 40 or 50% loss, was negative 23% return. Even with 6 out of the 12 months being bearish. What's the explanation? And Chuck, eventually I'm going to talk to you about how you're having great success with the bear calls. I did not trade bear calls at all in 2019, and that I think is the key. What's the key? And these type of movements, and the movements I kind of expect with the easing when I see this bearish sell warning, the movements down are quick. Meaning that if I opened a bear call credit spread today, planning on it, that was 30 days out, even with an 85% probability, I might see 5 to 8 days of a decline. And then the next 12 days, it might be back up. It's hard to do bear calls, even with weekly options, to catch these short bursts that we saw in 2018 to be profitable long term. Because the long runs, you start closing more positions that are wiping out the 2 or 3 gains you had at that month, the 2 or 3 gains you had at that drop, the 2 or 3 gains we had here. This probably negated most of those. That's the trick. Whereas here, bear calls probably would have been harder to get bear calls here with that run up. But from there to here, Iron Condors might have been okay. Bear calls might have been great, Chuck. And even in the last, up until the last, 20 days or so, that might have been pretty good as well. But again, it just seemed odd to me that what, people ask, and we assume, even as traders, hey, what's good for the goose is good to the gander. If I can see 30% returns, 40% returns in a good month using this bullet put structure, and even see an 11% return where 6 out of the 12 months are negative, that's successful for bull puts. Let me just reverse the criteria and open bear calls, and it doesn't work, even when 6 out of 12 months are negative, because they were in short bursts. It wasn't a gradual decline. And here you see more of a gradual move upwards, which you can go further out of the money to set the structure for, Chuck. And I think that's where our differences have occurred. You've got a pretty good structure there. And Sam has commented on this too. In this bull market, in this bull market, he didn't want to get in the way of the freight train. It was hard to do bear calls, and that's what I experienced as well. And in 2018, I always find it hard to do. And, right now we're not in a bear market, and the movement has been strong as well. Zaid offers another comment. He says, I've been doing bear call credit spreads for the past 3 months and pretty much lost on all of them. Oof, that's not good, especially Apple. Yeah, Sam had mentioned that. Now is not a good time to sell calls, either naked, covered calls, collars, or bear call spreads on that brutal run upwards, Zaid. It's a shame, but it's on the wrong side. It's very hard to say, oh, we're at a top. Let's go ahead and start selling the bear calls. Because people were saying that here, and Saeed, unfortunately, I think you said that too. People were saying that to me here, and it hasn't yet. When it starts, that's when we might look to do it. It's not too late, but when it starts, it's when you might look to do it, not when it's still having this run up, as Sam mentioned, in that case, okay? All right, so, Sam was just commenting on the Yandex at an all-time high. 3 is no resistance at 47. If the market is powerful, then Yandex can go to 50, and the 47 will be ITM. Yeah, so that's what I'm looking at on that one, but I've got to watch my triggers, just as you mentioned, Sam, if things start to ease in the next little bit. And that's why I want to bulletproof it and leave the upside open rather than just sell the call, as you mentioned. Okay, as well in that case. All right. Chuck did have a follow-up, and I'm not going to be able to get to it today, but Chuck, I'll be able to point you into a direction. He says, can you view the history? Yeah, when you go here, you can click the View Overall Sentiment History. And a few months ago, we showed what happens the last time there was a market pullback when the sell warning hit, and then we saw a bearish sell, and it was accurate. And we went back last year, just on that chart I showed you, January of last year, we talked about what the market sentiment indicator triggered, and guess what? January 30th, it had a bear sell. And right here in March, after it climbed back up, we saw that bear sell warning. Here was mostly neutral. Here and here, guess what they were? Light buy to buy. Then would have been a good time, good short-term buy. We saw the sell warning up here, not the bearish sell. We saw the sell warning here, and then that started. We had a light buy here, which worked for about 15 days. And here was the strong buy. December 26th was a strong buy on the market sentiment. Yep, that was accurate, wasn't it? As long as you weren't doing inverse ETFs or anything like that. So I'll have to point those out to you, but we have shown the history in the past when those questions have come up during Friday discussions and other webinars, and you can see it when you click on overall history as well. Chuck, all right? So I'll try to make myself a note for that. Can't promise you I'll get you an email this weekend, but I will try. All right. So, ladies and gentlemen, oh, sorry, that's it's about 6 o'clock, so I don't see a couple other comments just came in. Okay, sorry, it says, what I meant is to do bear calls when the sentiment is saying sell. Yeah, I haven't triggered that. I haven't done that much of an in-depth look, but I know that the sell warnings projections were right, and the buy warnings were right as well in that case. All right. Well, ladies and gentlemen, let's see there. Terry's other questions. All right. Today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. I told you kind of what I did with the VIX calls because it was at a low, yes. I told you that I'm not opening bull put credit spreads. I'm not saying what trades I'm opening. I'm saying I'm not doing bull puts. And I told you what I'm doing with the Yandex position that was posted for Fusion subscribers to bulletproof it on Tuesday, but I made no direct recommendations of what stocks I'm buying, getting into, or now is a good time to get into Yandex as well. Options, of course, involve risk and may not be suitable for all investors. We didn't do a lot on the tools today, but we showed a little bit of the profit and loss chart, looked at the portfolio tools, some of the searches, selecting the columns for beta for that discussion with Jerry. If you want to check out the tools, remember just go to PowerOp.com at any time, put in your name and email address, and you'll get full access to the site for 14 days, no credit card required. After that, subscriptions start at $45 per month with higher subscription services for more access to historical and real-time data. I'm going to have to adjust that picture. I didn't realize I was cutting off the subscription levels. I'll have to redo that too. We talked about some of the free education out there. Remember, you can check it all out, blog.powerop.com. Just showed where the Beyond the Credit Spreads Part 2 is, where I discussed that comparison of how bear calls compared in 2018 to bull puts, which I was kind of shocked at, where the goose, what worked for the goose did not work for the gander in reverse. But you can see all of that at powerop.com/webinars.asp. Remember, always check us out on YouTube at any time as well. And, of course, you can also send me an email at any time to support@powerop.com or support@radioactivetrading.com or call me during office market hours, 302-992-7971. Ladies and gentlemen, have a fantastic extended weekend. Remember, markets are closed on Monday, the 20th, okay? So remember, we got an extra time value decay for those positions that we sold. We'll be back at it on Tuesday. Fusion subscribers will probably see some adjustments to the Yandex and Fabrinet trade that have been placed, and possibly to ON, the semiconductor one I just continued. And we're going to keep an eye on that market sentiment tool very, very closely. I'll try to get as much of this posted for you this weekend. Terry's section will be easy to split out once it converts, the first full 30 minutes. I do want to get the discussion we just had on the market sentiment split out because I think that's important, but all of this is going to be split out and posted on Power Options and, of course, on YouTube for you, hopefully by Sunday, definitely by Monday when the market's closed. So, ladies and gentlemen, take care. We'll see you soon. Have a fantastic extended weekend. Thank you for your questions. Thank you for your comments and assisting me with the questions, and we'll see you soon.